Business owner, if you struggle to learn how to day trade, I'm going to give you here a 1-minute trading strategy, and I hope that it will literally help you to make this as a profession. That means as a living. So first of all, the money management is what we're going to talk about, and then we're going into the charts. I'm going to show you how money management works. That means how can we adjust $100 on average to make $500 on average with each signal that we see that works, and when losing just the $100 of loss. Here you can see how a trader lost 9 times, won 5 times. And what is here very important to see is that you can see here the 9 times losing was $900, the 5 times winning was $2,500, and the trader still made $1,600. And then when getting better, here you can see another trader that has just more market experience. The trader had like 19 winning trades, 6 losing trades, lost $410, made $7,344, and in total it was $6,934.38. What is very interesting here is the money management. That means you can see here how the trader loses $70 in average, but makes, as you can see here, 371, 447, 385. So you see like 3 to 5 or even 7 times way more than what the trader loses in average. And how this works is to have a 3-step method. The 3-step method is so good that you just can trade within 1 or 2 hours, and you would have 20 to 50 signals by trading 4 to 5 weeks, like 2 to 3 times a week, whenever you're available between 9 a.m. Central Time to 4 p.m. Central Time. So we will look at a couple of 9 a.m. Central Time market conditions. And important to understand is that there are different kind of markets. That means if you trade, for example, gold and silver, the problem is that these markets are way more spiky than the S&P 500. If you trade the S&P 500 futures, the awesome thing is it will run into a trend for 30 minutes up to 5 hours, and it will be way more easier to trade than just let's just say trading gold. Because when you can see that the market is let's just say it like that, when you see that the market is trending for 30 minutes in one direction, then you can assume the market is trending another 30 minutes in one direction. But if you trade gold, for example, and you see the market is trending for 30 minutes in a direction, it just turns around instantly. And why isn't the S&P 500 is not that fast turning around is because the S&P 500 is very heavy. So you have Meta, Facebook, you have Google, you have Apple inside, you have Amazon inside. And the thing with these companies is that people are very heavy invested, that the market just cannot turn around just within 5 minutes. It's just not possible. We're talking about $70 million just on one price point, just that the market is being moved. And because it's so much money, the market needs like 30 minutes, also like sometimes up to 5 hours even to turn around. And this is something what is very efficient for us, because when we, for example, start our trading here at 9 a.m., as you can see here, this is 9 a.m. here, and you look just at the past, you just see here the market was going lower since 1:30 a.m. to 8:50 a.m. So you can see like already for like 9 hours, the market was already going down. But a bit here in a consolidation phase, as you can see here, a true push was coming from starting here where my mouse is. That means from up here from 6:50 a.m. to like 9 a.m. That means like 7, 8, 9. So you see already the market was running here already down for 2 hours. And now because the market was running down from here to here for 2 hours, we could assume that the next 30 minutes when we start trading here, minimum at least, that the market also wants to go down. That means if I mark here the 30 minutes from 9 to 9:30 around, you see here how the market is continuing here to go down, right? So there are now 3 types of market phases, what I would like to teach you with money management. That means this is one of the best things, is that when you start trading, you see the market is going up or down in any direction, just assuming the market continues to go in that direction. The second one is that you see that the market is literally in a very, very big area inside where it likes to go back always. It's like a specific point in the middle where you see that the market does a lot of candles and then it just pushes away and then it comes back there. Really, really nice. But the third one are small consolidation phase. It looks like number 2, but it's just so small that we just cannot have a green candle, adjust $100 to make $500 in average. The problem here is just that when you adjust here anywhere $100, you maybe just make $50 or $150, and that's just like not that nice. Even though if it's $300, a risk reward ratio, that means when adjusting $100 should be always $500. That means it should be always 5 on average for each signal. And this is something what I see with most beginners, that they start making money or that they have a massive advantage in their trading. So when you see, for example, the market did a specific length, as you can see here, assuming that the market does around the same length or just a bit lower, like 50% of it. And then when being here able to adjust here $100 here in this area, I make this one a bit bigger, we can make here $500 within this length. Also here in this area, we can maybe here in this area adjust $100, make $500 within the length like that. Down or up, by the way, it's just exactly the same. Like we can trade upwards, we can trade downwards to this area here. And on the third area, if you, for example, adjust here $100, that's just like $100 here when it comes to length. So how trading works, and this is something what's very important. If let's just say we have here like 3 green candles, looks like that. We have a red candle to see how strong the seller is. Now we have a tiny green candle. I really like tiny green candles. And the main reason is because we can adjust here from entering the trade here to here with a lot of leverage trading futures, $100. That means when the market goes down there, we would lose $100. But if the market goes up, that means if the market just does this kind of candle one more time, that will be for each this length where we adjusted $100 and making money. That means 100, 200, 300, 400, $500 up to in this area here. And that's just something what is very important when it comes to trading. And I'll show you how this works in the chart. First to understand before that is that when we, for example, let's just take $10,000 and we divide it into like, let's just say like 20 trades. When we adjust here $500, we want to make minimum $2,500 for each winning trade. And the thing is now that we don't want to spray just $7,000 in a single week inside, because there are weeks where the market will be more spiky and there are weeks where the market will be more trending in a direction. So I'm going to show you this one here in a 1-day chart. We're going here to 1 day. So each day, as you can see here, each candle is 1 day. Very important. So here you can see, for example, that the market is for 4, 5, 6, 7 days just going straight up. Pretty nice. In this area here, you can see the market is staying a whole week in one area. And we just don't want to spray here $7,000 inside into this area here. It's important maybe to put here inside, let's just say like 3 to 7 trades. That means like $500 a trade is like 3,500. Let's just say with $500 a trade is like 1,500 to like a $3,000 we would like to place here in this area inside. And then here, for example, what did we say? We say it like mathematically with the calculation, we put, for example, $10,000. You need to take your calculation shortly. We take $10,000, for example, divided into 20 is like $500. And then with $500, it's very important that let's just say like $1,500 to $3,500 we would put an average in a week, an average, so that we have 20 trades. So if you trade with $3,500, you could sustain like 3 weeks. But if you trade like $1,500, man, like you could sustain like 7 weeks, right? So that's something what would be better. Because we need to read a bit. When do we see that the market is just in one area, as you can see here? And when do we see that it's literally pushing in one direction? And the main answer to this is you can see this very well. If the market goes to a high, that means like a green and a red candle in the highest point, as you can see here. And the market is touching it for the first time. Before the market is touching it, you will see that it trends very nice. That means here putting inside like 2 to 3 trades or 4 trades even here in this area here. But once the market touches it, not trading in this area too much is very important, unless we see that the market is here, again, pushing up to this high again. And then you can see here it touches the high again, and then not trading at all here in this area. And you see here 1, 2, 3, 4 in this price area, 6032.50. You see here 4 candles, right? So that's not that nice to trade. And also when the market is above a high, you will see very often that it comes back, it dips back. So trading when it dips back is sometimes good. We trade less there. But what is really, really good is if we have like something like a bigger structure high, as you see here, and then you'll see like the market is structuring for days. We need to wait sometimes, but when you see like it's pumping up, we can assume that it wants to go here to this high, and then literally placing 3 to 7 trades within that week in average when we see that the market is pumping up, as you see here, as you see here, or even there, right? And then every time the market is just like, as you see here, just in a consolidation phase, was touching already a specific high, like before it touches is good. And then after the market touches the high, not trading here at all, above it or at it. It's just something what is very important when it comes to money management. And what just happens is then, as I'm showing you here, you can see here 1 week, 2 weeks, 3 weeks, for example. This trader placed within 3 weeks 25 trades. The main reason why the trader trades here so much is because it runs. So the trader was adjusting $70 and then made $665. And then with the $665, the trader can now afford almost 10 more trades before even losing money. And this is the main reason why we can then trade more if it sustains. But of course, if the market is harder to trade for beginners, it's just important to place maybe 3 to 5 trades a week in average. And then when having this risk reward ratio of 5, this is where it gets very interesting. So we will go now here to the 1 minute chart. We will look at specific times from 9 a.m. to 4 p.m. It's pretty cool. So that means where this gray area is ending here. This is where 8:30 is. This is where the US session is, starts. It's important not to trade there, just starting 30 minutes after. And what you see here is that the market was trending down for 1.5 hours. And when that happens, you want to look or to the left, and you can see here already a bigger structure high, low, I mean. Bigger structure high is up here. This is a bigger structure low. And the next bigger structure low is down here. And when the market has the big distance from a bigger structure low to another bigger structure low, it takes the market a lot of energy to get down here. So very often the market is pushing down, touching this violet line, as you can see here, and then it starts to consolidate. So what do we do if we want really to trade there? The answer is there that we placed an indicator that is called the anchored VWAP. You'll find this one here on the left side using TradingView. We place the indicator on the bigger structure high, just where the push came from. And then you can see here, we let the market touch this bigger structure low here on the left side. And once the market touched it, or was very nearby, this is something what's really important. We wait how the consolidation phase looks like. Because when, let's just say here, when you have a high, and you see the market is touching it, always insist to assume that the market will go here in a consolidation phase. If it looks like this, it's not worth it to trade that much. But if you see it develops like this with higher lows, that's really nice, because now we can place here an anchored VWAP. We have here a nice line that is cutting in. We can have here a smaller stop loss. That means entry, stop loss, adjusting $500 to go for $2,500 up here within a specific length, what the market did here already. So the idea of the anchored VWAP is that when you see a push and then the market comes back, this push here that you see here is what the market should replicate here again after the market was dipping in or like going very nearby to the anchored VWAP. If the market is pushing enough, it's not going to touch the anchored VWAP, by the way, sometimes even going under it. That just depends on the personality of the market. That's why you need market experience. But what I can give you here is that we wait here a bit. You see that the market is retracing within this length. Now check this out. The market is here a second time around retracing within this length. As you see here, does here a couple of red candles above this line here. And then when adjusting here $100, check this out. Selling where the red candle is with the color switch. And now aiming here for this low again to touch. You see here the risk reward ratio is 5.75. That means $100 adjusted. This is a $500 winning trade, right? So now the thing is, now we would be maybe stopped out here in this area. And this is already all right, because we can always enter a second time. So each trade needs always a second opportunity. That means we never trade just a movement, just placing one trade and set and forget, it's called. So what we do is better is we see the signal, we trade actively, and when we get stopped out, we try it a second time if we see that the market was trending for 1 or 2 hours, as you can see in one direction. And if we see that it makes sense trading here to this lower point. Let's just look at another day at 9 a.m. So we go here a bit like back. You see here, this is another day here. We go here to 9 a.m. We take a zone here. That means here, for example, and then to 11 a.m. And what we see here now, if you make the chart very small, you see here the bigger structure high, and you see here the bigger structure low. And as I just said, if you see a bigger structure high and the market touches it, assume always that the market goes in a consolidation phase, because this is what just happened here. We let the market consolidate, and you will see then in your trading progress that the market does again the same retracements from here to here. Then it does it again from here to here, as you can see here. And what is really nice now is that you can see that the candlestick bodies. I will use an indicator that is called the Epic Pen. I really like this drawing tool, because I can just show you here nicer things. When you see that the candlestick bodies from here to here are just going higher, and you can see it goes here higher, and the market starts to structure with higher lows. Just concentrate on the lows. The highs doesn't matter. Just concentrate on the higher lows. That shows us that the market wants to go to this bigger structure high now, then to this bigger structure low here. So we always have the decision, do we assume now the market goes up here or down here? You can see for several hours, again, the market is going up. You can see in the consolidation phase, it does the same retracements. And because of that, now it is because we have just one direction that is clearly in this area here, or starting here around. Where can we adjust $100 to make $500? And the answer to this is always just using one setup, one signal to use simplicity. That means a red and a green candle entering where the green candle closes, stop placement under the color switch red and green, and adjusted $100 we have up to here already $600 as you can see here, so we can just exit where $500 would be reached. Why we should exit when the trade would run like $700, $800, or even $1,500 when we are just $100 at $500? And the main reason is about making money. So a money making activity is that when you have, for example, like 5 to like 10 signals a week, where you can see that you can adjust $100 to make $500 on average, or even $500 to make $2,500 on average, then you really want to be and this is something what's very important. You really want to be able maybe to have 3 winning trades of $500 and maybe just 7 losing trades of $100. That's really a lot, but for somebody who's in the beginning, that's realistic. And if you just calculate that up, that's literally still making money of $800. So making the first $3,000 to $15,000 trading with real money, I think those are one of the most important learning curves what every trader needs. So that means like maybe starting with a $500 account, adjusting $10 to $15 a trade, and looking forward to make like $50 to like $75 a trade. That's something what is very realistic. Making the first $100 trading micro futures, and then from there on just like trading instead of the MES micro futures, trading the bigger futures. Very important. This is not a financial advice. This is just my opinion, what I really love when it comes into trading and how I would do it when I would start over again. In another video, you will see how I adjusted $1,500 within one trade. I lost it, but within the other trade, I made like around, I think it was around like $16,000 or $17,000 or something. I'll just put the video under this video in the commentary, so you can just have a look at it, how it works. So there are specific other tools that you can use than the 1 minute chart, like a heat map or a footprint. But the thing is, like, if you can already adjust $100 to make $500, as I'm saying with the calculation, it is to learn, I think, to trade with a demo account, a not real money account, a lot first, to see, can I make even $400 or $1,200 within a month or within a week sometimes? Can I use the money management well? Everything I said here. And if that's the case, I think it's just to crank it up with trading with real money first. And then once that works, learning how to adjust $100 to make $1,500, trading above highs or lows, or using volume. I think these things are would be just better once the trader made already $20,000, $50,000 and can even afford a trading platform for $3,000 or $5,000 in total, because these trading platforms are very expensive. And a trading platform like TradingView is something what you can trade with real money almost absolutely for free. You would pay around, I think it's just like a free version at $5 a month or something, and the demo account and the first smaller real money account even by just using the absolute free version. If you use the paid version of TradingView and you just say if it's just like $30, that's still $360. And the student that you see here that made almost $7,000 here, $6,934, started with a $500 account, just for your info. So instead of paying now $360 a year, maybe it's motivating you to even use the free version for TradingView, and I hope this will literally help you trading out.